Yes, sir. We are live on YouTube as well as on Zoom. Good afternoon, participants. Welcome to the live session of the course Essentials of Financial Management. Our course instructors, Dr. Abhijeet Biswas sir, is here, and Dr. Shashi ma'am will also join soon. And our teaching assistants, Ms. Apurva Singh and Ms. Nirun, both are here. Kindly feel free to join in and clear all your doubts. Thank you. Over to you, sir.
Okay. So, am I audible, right? Voice is clear. Okay.
Yes, sir.
Huh. So I'll start with we have received few queries. So I'll start with the first one. A student, Devika, is asking, could you explain how arbitrage works in capital structure with a simple example? So I think I've explained this concept in detail in the third unit when we are discussing about the concept of capital structure. This question is related to the Modi-Glanil-Miller approach of capital structure. So we have four approaches, and the final one is theory. So there, we have a set of assumptions. And it says that one of the assumptions says that the if under certain set of conditions, if two identical firms which are similar in all aspects except their capital structure, that is, one might be using debt, one might not be using debt, or except their capital structure is not same, they will have same market values, right? So this is the basic assumption behind this theory. So for example, this why this happens, this happens because let's say there's a company which is using debt, and there's a company which is not using debt. X is using debt, Y is not using debt. So normally what will happen, again, this I'll try to mention that this theory is actually a conceptual theory. This is if a company is using debt, it will have a more market value, right? And if a company is not using debt, it might not be having more market value. But if these two firms are similar in all aspects except their capital structure, the firm which is not using debt, the investors will try to shift towards that company because they can have more returns and they will not be taking that much of risk. But what happens is, if the investors are moving towards those companies which is not using debt, they also have the liberty to use personal leverage as against the corporate leverage, because that company is not using debt. And because company is not using debt, they will have to use personal leverage. This is known as the personal leverage. They will get involved in taking loans from their side. This will be equivalent to their proportionate shares in companies X debt, right? And whatever they raise, they will also invest the same amount in company Y. So in this way, the prices of the company which uses debt, market shares of the prices, will actually keep going down, and the market prices of the shares of the companies which was not using debt will actually keep on going up. And this entire process will continue till the time the market prices of the shares of both the companies are same. So this concept is basically known as the concept of arbitrage. So I've explained this in very detail with the help of numerical in the capital structure theory. I think she's talking about that part only. So I'll move to the next question. Uh, Fatima has mentioned that why is the NPV method often considered superior to the payback period method, and how do firms practically account for risk when evaluating the capital budgeting projects? So here she's trying to understand why NPV is better as compared to the payback period. So first of all, we'd like to clear that these two methods are categorized under two different categories. When we talk about the net present value method, it is basically under the discounted cash flow criteria, right? Where we are taking into consideration the time value of money, the cost of capital, and all those things. And we talk about the payback period method, it is classified under the non-discounted cash flow criteria, where we are not taking into consideration the time value of money or the cost of capital. Any day, discounted cash flow criteria are far superior than non-discounted cash flow criteria, because when we are taking time value of money into consideration, we are trying to we are trying to use a discount factor, which is considered, which here we are taking as the weighted average cost of capital. We are trying to convert the future benefits into present value. For example, we cannot say that 10,000 today will be equivalent to the 10,000 after 5 years. So we need to convert future benefits to present value to get a realistic picture. So when we talk about the net present value, which basically takes into considerations the present value of cash inflows and we deduct the present value of cash outflows, we get the net present value. So here we get a clear picture, right? We get a clear picture. Whereas when we talk about the payback period method, it is a very simple method where we do not use any discounting factor. We do not convert the present future benefits into present value. And that is why I think NPV is far better method as compared to the the payback period method, right? And the next question is from Jitendra, and he's saying that when making financial decisions, how should a manager balance between short-term liquidity and long-term profitability? Right. So normally this is a challenging situation for any manager to strike a chord between the concepts of liquidity and profitability, because normally what happens if you emphasize more on liquidity, that is having more of liquid assets, you might not be emphasizing more on profitability, and if you emphasize more on profitability, you might not be putting much of your liquid assets with you. So they are actually, it's a challenge. But if you try to make a, you can balance between these two. One of the ways is like you have to do proper inventory management. You have to make sure that you have to ensure that you do not invest too much in your inventory, because your capital will be tied up in that way. And also you have to ensure that you do not invest too less in the inventory, because the risk of stockouts will be there. So you have to maintain an optimum level of inventory for this purpose. So that is one of the things. Then you can also be focusing on receivables management, whereas as far as the receivables are there, you should be very prompt in collecting your receivables. Whenever they become due, you have to collect them as quickly as possible. As far as the payments are concerned, you should try to extend the payments, and if possible, you can get the extensions. So these are few of the ways in which you can manage your cash flows in a much better way. So with these small changes in your receivables management, in your inventory management, in your cash management, you can have you can achieve the balance of liquidity as well as profitability. The next question is, what are the major considerations a firm should keep in mind while choosing different debt and equity financing? Okay, so here the students wants to ask, what are the conditions when a firm should go for debt? What are the conditions when the firm should go for equity? So it's related to the capital structure part, selection between debt and equity. So there are multiple factors. We can say these all factors can be considered as the determinants of capital structure. Capital structure is basically the proportion of debt and equity mix. So what are the determinants of capital structure? For example, for let's say a company is having a lot of fixed assets. So they have the liberty to go with more of debt, because usually when you take loans, you get debentures and all those things. So basically what happens is you have you keep your fixed assets as collateral. So that might be one of the factors. Similarly, you can have the we can say that the age of the firm or the scale of operations that you have. If a firm has large scale of operations, they can go for more debt. Or if it's established firm, they have the liberty to go with more of debt as compared to the startups. They might not be having that much of things. And other factors apart from this, which we can say are the determinants of capital structure, are basically you can say the okay. Okay, I think this apart from this, if we can say, if we have anything.
No other questions posted, sir, other than these things.
I'll just looking to the questions 1 second.
Okay, sir.
Okay, what are the okay? So yeah, we can also talk in terms of the principles of capital structure when we talk about the debt equity mix, right? So basically, we have 5 principles of capital structure. We have the cost principle, we have the risk principle, we have the timing principles. So when any firm would like to minimize the cost, so if that is the thing, you can always go with debt, because debt is considered as a cheaper source of funding as compared to equity, if minimizing the cost is the major objective. Similarly, for example, if you want to have more of control, So in that case, you will not be like to lose the control. So in that case, you will be not issuing much of equity because your control will be lost. Existing stake of the existing shareholders will be lost. In that case, also you can go with the preference share capital. You can go with the equity share. Sorry, you can go with the debentures or bonds, but you cannot go with more of equity. Similarly, if you want to minimize your risk, if that is the criteria that you want to have, so in that case also you can use more of equity, because debentures will increase the risk, right? Because it's a legal obligation to pay. So in that case, equity can be a choice. Then the timing is also one of the factors. Sometimes the stock market is going through a good phase, sometimes it is not going through a good phase. So normally if it goes through a good phase, so you can issue equity because the investors might be seeing a bright future of the firm. On the contrary, when the stock market conditions are not good, it's going to a gloomy phase. In that scenario, you can use more of debt because investors might be apprehensive in getting the equity. So these are few of the factors which determine which form of securities the firm should use, whether the equity or the debenture or whatever it is, right? So let me look at the next question. Okay, so I think these are the how relevant is okay how okay. What are the major considerations a firm should keep in mind? Okay, this I think we have done it. How relevant is lease financing in today's business environment compared to traditional bank loans? Okay, so here the student wants to know what are the benefits of lease financing as compared to traditional loans from the bank. So basically, the major advantage that you have in case of lease financing as compared to the regular loan I'm talking about, you don't need to have the hassles of collateral because the asset that you take is considered as a collateral. You do not get the ownership, right? But the hassles of collateral is not there. You are not forced to pay the upfront fee of the asset. That is the main benefit of lease financing as compared to the traditional bank financing. Although we have certain schemes through which we can avoid hassles of collateral, like we have the CGTMSS scheme, but here the question is basically restricted to the regular bank loans that we are having. So we are away with the then we are not going into the hassles of collateral as far as the lease financing is concerned, right? And I think there is one more question. What are some modern techniques businesses use to optimize inventory levels? Okay, without affecting production. So there are many methods as far as the management of inventories are concerned. I'll just speak about two or three. I think Madam has already discussed this thing in detail. So one of the techniques is the ABC analysis. So what we categorize inventory into three categories, and the inventory which are most valuable are put into, but will generate more returns are kept under category A. Then the second level is category B, and the third level is category C. So we emphasize more on those categories which will, although they quantity wise they are very less, but value wise they are actually very high. So this is one of the categories. Similarly, we can have the VED analysis, that is the value that is the vital, essential, and desirable. So all those inventories which are very vital and without which the company cannot run, they are classified under the vital. And then the second one is which are important, but their quantity can be postponed till some time. They can be considered as essential. And the desirable are those for without which also we can work for some time. So these three categories are there. Apart from that, we have some other methods like safety stock. We can maintain a buffer stock, or we can also use the just-in-time inventory methods, where we try to minimize our investment in inventory. But for using this kind of methods, we need to have a very good coordination with the suppliers, right? Because the inventory reaches to our workplace just few hours before they are put to use. So in this way, we can use the just in time methods. So these are few of the methods that can be used to optimize inventory levels, or just manage the inventory. I think these are the questions that the students raised. I think I've answered all of them.
Yes, sir, you have answered them in a very elaborative manner with a lot of examples. So can we wait for 2-3 minutes, sir, in case if somebody joins and posts?
So any other questions? I think any student has
No,
joined.
no, sir, not at all, sir. On
Uh,
YouTube also, they are not watching, sir.
so we
So
can
I'm
wait for
checking.
5 minutes, and I think
Yeah, sure, sir. In
yeah.
case if there are no queries, then we will wind up, sir. Just in case if you want to discuss something in general related to our course, you can go ahead and discuss, sir, before concluding.
Okay, I think I'll just again give an overview what we discussed in this entire 8 weeks. So we started with this course is basically useful for all those students who are trying to get a feel of finance. So we started with the basics of finance. In this, we discussed about what is financial management, what is wealth maximization, what is profit maximization. All these things we discussed, and then we moved towards the capitalization, where we discussed about the concept of overcapitalization, undercapitalization, the optimum level of capitalization. And then we moved to the various capital structure theories. We started with the first theory, that was the net income approach. Then we moved to the net operating income approach, followed by the traditional method of the capital structure, also known as the intermediate approach. And finally, we discussed the Modi-Gilani-Miller approach. So this was the third unit that we discussed. We also discussed about the pecking order theory, which is not typically the related with the all the four theories of capital structure, but although we have discussed that part, then we moved to the very important part where we talked about the concept of this financial leverage, also known as the trading on equity. So we discussed about what is financial leverage, what is operating leverage, what is combined leverage. We also discussed about the financial break-even point, break-even level of EBIT. All these concepts we discussed in the fourth unit. Then we move to the sources of financing, where we discuss about the long-term sources, short-term sources. Then we move to the working capital management, where we discuss about the management of receivables, management of cash, management of inventory. Then we move to the seventh unit, that was the capital structure, capital budgeting, where we classified all the techniques into two broad categories, that is the discounted cash flow criteria and the non-discounted cash flow criteria. Discounted cash flow criteria, we discussed the NPV method, the IRR method, the profitability index method, and the discounted payback period method. In non-discounted methods, we discuss about the payback period method and the accounting rate of return method. And finally, the last unit was the dividend decisions. We discussed about the three kinds of dividend decisions. That is the Walters approach, the Gordon's approach, and the Modigliani and Miller's approach. So this is the brief overview of the entire 8 units and things that we have discussed. So you're not audible.
Yes, sir. We got one more question, sir. Can you just check that sheet, sir?
Okay, just let me.
I'll just
Where is the question? Conversations.
in the
where
sheet
can-
itself, sir. In the sheet itself, sir. I'm just
in the chats you have put it.
no, sir. In the Google response sheet, sir.
I
I'm
cannot.
just
I cannot see the questions.
okay. I'll just read the question, sir. How does risk return trade-off influence the choice of an optimal capital structure in real world companies?
How does the risk return
Risk
trade-off?
trade-off influence the choice of an optimal capital structure in
Oh.
real world companies?
Okay. Even 1 second.
Yes, sir. I'll just repost that question in Zoom chat, sir. 1 second, sir.
Have you put it the question somewhere? Posted it.
I'll post it here,
You
sir.
just post.
Are you able to view now, sir? In the Zoom chat. Yes.
कुछ बोलना ये मेरा क्वेश्चन है रिस्क एंड ट्रेड ऑफ इन्फ्लुएंस आप लोगों ने सारा आंसर कर दिया सारे ही बोल दिया ओके गुड थैंक यू इस पे कुछ है इसको कोई प्रॉब्लम ना so the question is how does the Shashi ma'am has also joined, so if she wants you can address her also.
Yeah, good afternoon, ma'am.
Hello.
Yeah, sir has answered almost all the questions, and the last question we received was, how does risk return trade-off influence the choice of an optimal capital structure in real world companies?
इसमें स्पीकर मेरे पास इशू है क्वेश्चन ये बोला क्वेश्चन पूछा से
Okay.
कोई आपको किसका आ रहा है
Actually, the risk return trade-off is directly related with the choice between the debt and equity, right? So if the company want to increase the return, however, the risk will increase with the inclusion of debt in the company. The company can go for it. But if the company wants to play safe, they would infuse more equity in the company instead of debt because they are satisfied. They're compromising with the return. And at the same time, they don't want to increase the risk in the company. So this is how the debt and equity ratio becomes very, very important even in the real life company. We have seen companies undergoing bankruptcy just because for the greater return, they have included more debt in their capital structure. So it is not something that we read in theories. It is very much practical that how the company should have an equilibrium between the risk and the return. So every time company has to be very, very judicious in selecting their debt and equity capital in their total capitalization. So it is, and the measurement criteria is company can restrict their debt equity ratio up to 2:1. That is the ideal. Even if it wants to go somewhat, no increased debt equity ratio, but still there is a caution because every additional debt will increase risk in the company. So that's what. And I think the Professor Abhijeet sir has already told you the trading on equity concept, the concept of financial leverage, which is a double-edged sword. If you increase the debt, you might increase the return for the company, but at the same time, when if anything goes wrong with the return, the company would be finding it difficult to pay the interest and the principal. So that may lead to even a greater problem in the company.
Okay, just I'd like to add something. What ma'am has already said that. What ma'am said that normally we go for this financial leverage in order to increase the earnings per share. That is the one of the motivations behind using more of debt. That is the trading on equity. But because as already mentioned, it is a double-edged sword. It can increase your earnings per share, but it can also magnify your losses per share. In case you are not having sufficient profit or the company goes in loss, the losses per share will also increase. That the EBIT is not sufficient. So that is why it is considered as a double-edged sword. So company should always try to maintain a healthy debt equity ratio, and does because with every increase in the amount of debt, the financial risk will be higher.
Practical example.
Huh?
Can you take a practical example?
Huh.
I'd like to make you understand with a very a real world problem. Like suppose if the rate of interest on debt is say 15% and the return of the company is 20%, and we know that the payment of interest is an obligation for the company. So company can pay very easily the rate of interest, which is 15%, because the return is 20%. So no problem. But if the return goes down below 15%, like suppose it is 12%, now still company is under obligation to pay 15% rate of interest. Where from company is going to pay? Because the return is only 12%. So now out of capital, this deficit of 3% will be paid off. So that is how it becomes very risky to increase the leverage in the company. So we have to see we have to compare the rate of return and the rate of interest for any company at a given point of time.
So I think we have answered this.
Are you satisfied? Thank you.
Yes, students is watching the event on YouTube, ma'am. Hope the answer helps him. Anything would you like to discuss in general, ma'am? So far, we received only those questions. Anything related to the subject you wanted to discuss, ma'am?
Anything focus for discuss?
Maybe some tips related to examination preparation. So exam for this course is on
I'd like to
October
say,
24th. Yes.
in addition to material that I have shared, that is a PPT, there are some references. You can also go through it. And and if you have any problem, I can say, but I think you should deal with the practical problem related to capital busting, inventory management. No, so this will become important for handling the question during the assignments and also for the final examination. So don't just look at the PPT. If there are some reference material, please go through it. Otherwise, we both of us have tried to make the things very, very simple, with should be understood by the students of elementary level. That's our objective. But
Sure, ma'am. Sure, ma'am.
I hope they shouldn't have any problem.
Let me just check on YouTube, sir, whether any post is there.
Check the questions.
So right now, 5 students are watching on YouTube, sir, but there are no questions. Maybe we can wait for a minute, sir. In case if there are no queries, then we will wind up the session, sir.
Okay,
Okay,
no,
okay.
no.
Yes. Sir, one question is posted on YouTube chat. Are you able to view it, sir, or should I repost it here? Shall I repost it on the Zoom chat? Just a second, sir. Just a second.
Please post it on the chat so that
Yeah,
we can.
yeah, sure, sir. Just a second, sir. Sir, I posted it. Are you able to view it, sir? So the question is, if a company uses debt to buy back shares, how would that influence the finances of the company? It is from Mr. Manbir Baba. You are able to view it, sir?
Shall I answer? Okay. The question says, if a company uses debt to buy back shares, how would that influence the finances of the company, right? If company is using debt to buy back the shares, that means company is interested to reduce the equity shares. Okay, so here it means the debt equity ratio of the company would further goes in favor of the debt. Debt would be higher and equity would be lowered in this situation. So it is going to increase the risk for the company. If company is already having higher debt, then it would further enhance the level of debt in the company, and as a result, the risk of the company would also increase. So this is not a good option for a company which is not having a very, very good profit track record. The company is not experienced. If the product is very much subject to elasticity of demand, if the company is new. So if company is confident enough to have a stable return, then only company should go for this option. Otherwise, reducing the equity at the cost of debt is not a feasible option for any company. That's my submission. Okay. Anything Abhijeet like to add?
I think ma'am has already clarified it. If the company has very good investments in the pipeline where they are very sure that they will get decent returns from that,
Right.
and not without much fluctuations in the returns, then only they can go for more of debt by buying back their equity. If company is not sure about the returns or the fluctuations, in that case, I think replacing equity with debt is not a very wise decision.
Also decreasing EPS, earning per share also is decreased. And there is another question, whether the company is buying back the share with the existing debt or it is issuing further debt to buy back the share. That is again, okay. I presume that it is out of the existing debt company is trying to buy back the share. Still in that case also, it's not a good thing if company wants to increase the risk proposition of the company.
Thank you, ma'am. Thank you, and thank you, sir, for the answer. Maybe we'll wait for a minute, sir, if there are any follow-up questions.
प्लीज तो कोई नहीं देखता है बट कहीं से क्वेश्चन से आ रहे हैं थोड़े पहले वाले तो बता हाँ सुन तो रहे होंगे मैं क्यों ये लाइव स्ट्रीम है
There are no more queries, sir. So can we wind up the session, sir?
No more questions?
No more, sir.
Okay, I think that
Okay.
Yeah, sure, ma'am, sure.
Reading the platform, would love to interact with the students because that's the way we can solve their problems and address their queries.
Thank you.
Yeah.
Thank you so much.
Yeah. Thank you so much, Abhijeet, sir, and Shashi, ma'am, for this live doubt clearing session. It was very, very informative, and we hope our learners will watch this recorded session and benefit from it. We are closing the session now. Thank you all. Thank you to the TAs as well. So we are closing. Thank you. Yes.
Thank you so much.
Yeah, thank you all.